Let me introduce you to Dave. Dave's a widower. He's turning 71 later this year. He's got a daughter, Jill, and he's got a net worth of about $2.3 million. And of course, he's concerned about his retirement, but he also wants to maximize what he does for his daughter, Jill. So again, net worth is $2.3 million. And if we break that down, this is his vacation property, non-registered investments, and then he's got about $1.5 million in his RRSP. Dave's currently spending about $44,000 a year after tax. So this is the rent on the apartment, and this is his lifestyle expenses. We see income taxes are fairly high. They're high because I'm looking at 2022. And if we come here and look at his cash flow, we can see next year when he's starting to have to take his RRIF withdrawals, he's going to get an extra $38,000 a year after tax. And I think part of the question is, what does he do with that money? So let's take a look and see what happens if he gifts some of that money to Jill. And so I've set it up so Dave is gifting this amount, and these are the contributions to Jill's RRSP. And then Dave's also funding the tax-free savings account for Jill, and you can see that right here. Okay. So if we look at the final estate, or Dave's estate, and compare the two, we can see that if Dave holds everything to the end, Jill's going to receive about $2.9 million versus $2.4 million. But remember, Dave was giving money away. So we need to do a comparison side by side of Jill's net worth. We can see when Dave passes away, there's about $5.1 million versus when Dave has been gifting money, Jill's going to have a net worth of about $5.5 million. So there's about an extra, $450,000 there. Let's break this down just a little farther. And we can see here Jill's got non-registered investments of about 4.5 versus 4 million over here. But there's also in a tax-free savings account another 400,000, and then we've got some money in the RRSP. Now on this side or this solution, I did assume that Jill was going to reinvest the tax refunds that she received once she made the RRSP contribution. So it does make sense, it looks like, for Dave to do some gifting. The other thing that sometimes comes up when somebody has a large RRIF is the amount of tax that is going to have to be paid. So I ran a scenario where Dave actually did purchase some life insurance. Dave's willing to pay $30,000 a year for premium. He can purchase about $450,000 worth of insurance. And if we look at the estate on that, we can see there's about a $400,000 difference. Well, of course, we took $30,000 out each year to pay the insurance premiums. There is a bit less tax to pay. But again, let's do our side-by-side comparison. So we can see without the insurance, Jill's got a net worth of about $5.1 million once Dave passes away. And over on this side, we've got about $4.5 million. So in this particular case, it didn't make sense to purchase the insurance in order to maximize the value going to Jill. But it certainly looks like it makes sense to do some gifting ahead of time.